Picture this. You're sitting at your kitchen table on a Sunday morning, coffee going cold beside you, and you've got a few browser tabs open. One with your bank account, one with a retirement calculator, and one you've been nervously avoiding for the last 20 minutes. And you're doing that thing where you kind of squint at the numbers, like if you look at them slightly out of focus, maybe the math will work out differently this time. You're not panicking exactly, but there's this low hum of anxiety that won't quite go away, because somewhere between paying the mortgage, raising kids, taking the occasional vacation, and just living your life, the idea of actually being financially ready for the back half of it, that part got a little blurry. My name is Rick, and I spend probably more time than is healthy thinking about money. Not in a Wall Street, spreadsheet-obsessed way, but more in the human way. Why do smart, hardworking people end up feeling financially behind? What are the patterns? What are the things people wish they'd done differently? And more importantly, what's actually still possible? I've talked to people across a wide range of financial situations, read the studies, and spent a lot of time chewing on why so much financial advice misses the emotional reality of how people actually live. And here's what I keep coming back to. The biggest money regrets people carry into their 60s aren't really about ignorance. Most people knew, on some level, what they were supposed to be doing. The regrets are about the gap between knowing and doing, and the specific, sometimes invisible reasons that gap exists. So that's what this video is about. Not a lecture, not a checklist, but an honest, unhurried look at the regrets that come up again and again, and what they actually teach us about building a financial life that holds up over time. Because some of this might genuinely change how you think about a few things, and the earlier you hear it, the better. Here's the thing about retirement that nobody really explains when you're young. It doesn't feel real. Like, intellectually, sure, you know it's coming. But when you're 32, and the kids need shoes, and the car needs brakes, and there's a work trip you need to dress for, retirement is this abstract future person problem. It belongs to a version of you that doesn't quite exist yet. So, one of the most common regrets people have after 60, probably the most common, is that they started saving seriously too late. Not that they never saved, but that the urgency didn't kick in until their late 40s or 50s, and by then, the math had quietly turned against them. And here's why that matters so much. Why it's not just a save more money thing. It's a compounding thing. There's this concept that gets taught in every personal finance class and then somehow fails to actually register emotionally, which is that the money you invest in your 30s is worth dramatically more than the same money invested in your 50s. Not a little more. A lot more. We're talking potentially 3, 4, 5 times as much by the time you actually need it. Let me put a number to it. Someone who invests $500 a month starting at age 30 and earns an average 7% annual return will have roughly $1.2 million by age 65. Someone who starts the exact same habit at age 45, same amount, same return, ends up with about $303,000. That's not a marginal difference. That's a completely different retirement. And the only variable is time. What makes this regret so painful to sit with is how preventable it feels in retrospect, because it's not like the money was always there and people just didn't save it. Often, life was genuinely hard, genuinely expensive. The regret isn't really about being irresponsible. It's about not understanding the mechanics of time deeply enough to make it a non-negotiable priority, even when everything else was screaming for that money. The takeaway here isn't, you should have started earlier. Obviously, if you're watching this, you can't go back. The takeaway is, the second best time to start is now. And the urgency is real regardless of your age. At 40, at 50, even at 55. The compounding math still works in your favor, just with less runway. Every year of delay costs you something you can't get back. Okay, so there's this thing that happens to a lot of people that doesn't get talked about in personal finance circles nearly enough. Probably because it's a little uncomfortable. It's called lifestyle creep. And it's basically what happens when your income goes up and your spending goes up right along with it, quietly, incrementally, in ways that feel completely reasonable at the time. You get a raise. You upgrade from the apartment to the house. Makes sense. You've earned it. A few years later, you're doing well. You trade in the reliable but boring sedan for something with heated seats and a nicer brand on the hood. Reasonable. The kids are getting older, and you start taking better vacations. Still reasonable. The house feels a little small, so you renovate the kitchen. Reasonable, reasonable, reasonable. The problem isn't any single one of those decisions. The problem is that by the time people hit their late 50s and start doing the actual retirement math, they've built a lifestyle with a cost structure that their savings can't actually support indefinitely. The income was always there to cover the expenses until the income stops, and that's when it hits. I talked to a woman once, I'll call her Patricia, who had a successful career in marketing, a nice house, 2 kids through college, and a genuinely enjoyable life. She was proud of what she'd built. And then she sat down with a financial planner at 58 and realized that to maintain her current lifestyle in retirement, she'd need to either work another 12 years or make some significant cuts. She hadn't done anything reckless. She'd just spent pretty much everything she made, for 30 years, on things that seemed justified. What nobody tells you in your 30s is that frugality isn't really a personality trait. It's a skill. It's the ability to widen the gap between what you earn and what you spend, deliberately, and redirect that gap toward your future self. And it doesn't require misery. It requires intention. It requires occasionally asking, do I actually want this, or am I just upgrading because upgrading is what people in my income bracket do? The regret, when it comes, isn't usually about any individual purchase. It's about the pattern. It's about looking back and realizing that you earned a genuinely good income for 20 or 30 years, and somehow the wealth didn't accumulate to match it. Here's one that surprises people a little. One of the most common financial regrets at 60 isn't about spending too much or saving too little. It's about being too conservative with investments for too long. There's a really understandable psychological reason for this. Losing money feels awful. Like viscerally, emotionally awful. Studies consistently show that the pain of a financial loss is roughly twice as intense as the pleasure of an equivalent gain. So when the market drops, people bail. Or they never get in the first place. They keep their savings in a savings account, or in CDs, or in bonds, because at least there they know the money is there. What this feels like is safety. What it actually is, especially over a 20 or 30-year time horizon, is a slow bleed. Inflation eats your purchasing power. The money sits there in nominal terms, sure, but in real terms, what it can actually buy, it's shrinking every year. And meanwhile, the stock market, despite all its drama and terrifying dips and occasional crashes, has historically returned around 7% annually on average, after inflation, over long periods of time. The thing is, time is what turns volatility from a threat into an asset. If you're 35 and the market drops 30%, that's not a disaster. That's a sale. You've got 3 decades for that money to recover and grow. But if you never got in because the volatility scared you and you kept your retirement savings in a high-yield savings account at 2%, you've essentially left an enormous amount of wealth on the table. People reach 60 and do the math and realize that a different investment approach, nothing exotic, just a sensible diversified index fund strategy, would have produced dramatically different results. And there's a particular heaviness to that realization, because the information was always out there. It wasn't hidden knowledge. It just felt too scary to act on. Now, to be fair, and I want to be genuinely fair here, this isn't simple. Market crashes do happen. People do get hurt. The 2008 financial crisis wiped out retirement savings for people who were close to retirement age and didn't have time to recover. The fear isn't irrational, but the solution to that risk is a smarter asset allocation over time, not avoidance. As you approach retirement, you gradually shift to more conservative investments. You don't stay entirely out of the market for 3 decades, out of fear of a downturn. This one is a little different from the others, and honestly, it might be the most emotionally loaded. A staggering number of people reach their 60s having never had a real, honest, detailed conversation with their partner about money. Not a fight. Those happen plenty, but a calm, clear, mutually understood conversation about goals, fears, numbers, and plans. And what happens in the absence of that conversation is that 2 people can spend decades living under the same roof, sharing finances, and operating from completely different assumptions about what their financial life means and where it's headed. One person thinks they're on track. The other has been quietly terrified for years but didn't want to start a fight. One person thinks retirement is at 62. The other has mentally budgeted for 70. One person thinks the kids will be financially independent. The other has been lending money that was never going to come back. The regret, when it surfaces, is often less about the money itself and more about all the years of unnecessary anxiety or all the years of false comfort that could have been replaced by actual clarity. And then there's the conversation people put off with themselves, which sounds a little abstract, but it's real. How many people have genuinely sat down, not to look at the numbers quickly, but to deeply think through what they actually want their 60s, 70s, and 80s to look like? What does a good retirement actually mean to you? Travel, grandkids nearby, a small house with a garden, staying close to the city? The financial plan should follow the life vision, but so many people have no clear vision, so they end up saving vaguely, spending vaguely, and arriving at 60 with a vague result. The takeaway is almost embarrassingly simple. Have the conversation, sit down, with your partner, or with yourself if you're solo, and actually get specific. What do you want? What does it cost? What does the gap look like? And what would it take to close it? It's uncomfortable for about 20 minutes, and then it becomes the most clarifying thing you've ever done. There's a specific flavor of financial regret that I describe as the compounding cost of perpetual deferral. This is the person who always intended to get their financial house in order, get a will done, look into their insurance, consolidate old retirement accounts, actually understand their investment allocation, but kept moving those tasks to the next quarter, the next year, the next phase of life. And here's the thing about financial avoidance that's different from other kinds of procrastination. It's not neutral. Every year you don't have a proper estate plan. You're exposed to outcomes you didn't choose. Every year you don't consolidate or optimize old retirement accounts. You may be paying unnecessary fees or sitting in bad funds. Every year you carry the wrong insurance coverage. You're either overpaying or underprotected. The cost of inaction isn't zero. It's just invisible until it suddenly isn't. I've heard this one described as the "I'll figure it out later" tax, and I think that's exactly right. You pay it slowly, in missed returns and avoidable fees and suboptimal decisions and the opportunity cost of all the years you could have been doing better. And at 60, people sometimes look back and see that the version of them from 20 years ago was smart, capable, and perfectly capable of sorting this out. They just never made it a priority. What's interesting is that this particular regret is almost never about intelligence or financial sophistication. It's about activation energy. The tasks aren't that hard once you start. A fee-only financial advisor, an estate attorney for a basic will, an afternoon to log into old retirement accounts and see what's there. These things take hours, not months, but they require you to move from passive intention to active doing, and that transition is somehow one of the hardest things in financial life. So here's what I notice when I look at all of these regrets together. They're not really about money in the narrow sense. They're about time and attention and the gap between the life we're living and the life we're planning for. They're about how easy it is to stay in the comfortable present tense and avoid the slightly uncomfortable future tense until the future tense becomes the present, and the math is harder than it needed to be. But, and I want to say this clearly, none of these regrets are terminal. That's the thing. Even at 60, there is genuine opportunity. A decade of focused, intentional financial behavior can change the trajectory significantly. The investment math still works, just with less runway. The lifestyle recalibration is still possible, just with more intention. The conversation, the planning, the getting organized, none of that has an expiration date. The people who tend to handle this best aren't the ones who did everything perfectly from age 25. They're the ones who, whenever they got the clarity, actually acted on it. Who stopped saying, "I should probably deal with this at some point," and started saying, "I'm going to deal with this week." There's something quietly powerful about that. About deciding that right now, with whatever time and resources and information you have, is when you choose to take your financial life seriously. Not because you have to, because you actually want the second half of your life to feel like something you built. Not something that just happened to you. That's worth protecting. And honestly, it's never too late to start. If you found this topic valuable, like this video, comment your thoughts, subscribe to this channel, and I'll see you in the next video.